When someone who spent 95 years mastering money makes their biggest move ever, you need to pay attention. Because it's not about making more. At that age, with that track record, it's about protecting what matters. Warren Buffett officially handed over the CEO position at Berkshire Hathaway on January 1, 2026. After 6 decades building one of the most successful investment companies in history, he passed the reins to Greg Abel. But before walking away from day-to-day operations, Buffett positioned the company in a way that screams louder than any press conference or shareholder letter ever could. If you've got money in the market, if you're counting on your 401k to fund retirement, if you believe stocks only go up over time, what Buffett's doing right now should make you seriously question those assumptions. Because when the investor with the best track record in modern history stops buying and starts hoarding cash at unprecedented levels, when he offloads stocks for 12 straight quarters while everyone else chases AI hype and record highs, when he accumulates $381.7 billion in cash while others assume valuations don't matter anymore, he's sending a message without saying a word. He's telling you that what feels safe might not be, that what everyone believes will work might stop working, that the confidence you feel watching your portfolio climb could be the exact moment when the sharpest money in the world is quietly preparing for something completely different. This guy lived through 1970s stagflation. He saw the 1987 crash. He navigated the dot-com bubble. He survived 2008 when the financial system nearly collapsed. He made it through COVID panic. Every single time he positioned Berkshire to weather storms that destroyed everyone else. And every single time, people watching thought he was being too cautious, too conservative, missing opportunities. Until reality hit. Until assumptions fell apart. Until the only folks left standing were the ones who prepared while others chased returns. Right now, Buffett's preparing again. Not loudly, not dramatically, quietly, systematically, building the largest corporate cash position in history. And when Buffett moves like this, ignoring it tends to get expensive. Very expensive. Let me take you back to 2008 so you understand the pattern. Before Lehman Brothers imploded, before the financial system seized up, Buffett was doing something that confused everybody. He was selling. In 2007, while markets hit record highs, Berkshire reduced positions, built cash, sat on the sidelines. People complained, said he'd lost his touch, said the world had changed, and Buffett didn't understand complex financial instruments. Then September 2008 arrived. Lehman failed. AIG collapsed. Credit markets froze. Stock prices got cut in half. Retirement accounts evaporated. And Warren Buffett, sitting on massive cash reserves, became the lender everyone desperately needed. Goldman Sachs, General Electric, Bank of America. He made deals nobody else could make, at terms that generated billions in returns, because he had cash when everybody else needed it. The people mocking his caution in 2007 spent years recovering losses. Buffett spent years compounding wealth. That's the pattern. He doesn't predict crashes. He positions for them. He builds balance sheets that survive worst-case scenarios. And right now, he's building the biggest fortress in Berkshire's history. $381.7 billion in cash and short-term investments as of September 30th, 2025. That's not normal. That's not prudent diversification. That's preparation for serious systemic stress. Great investors don't predict markets. They read systems. When systems become unstable, smart money doesn't attack. It defends. This plays out in stages. Stage 1 is the confidence era. That's where we've been. Stock prices climbing. AI driving valuations higher, corporate earnings strong, unemployment low, markets hitting all-time highs repeatedly. Everyone feels confident. Retail investors pile in. Institutions chase momentum. The narrative is growth, innovation, disruption. Nobody talks about risk. Nobody prices in the possibility this ends. Everyone assumes this is normal. Markets stay elevated because earnings justify valuations and the economy remains resilient. Stage 2 is blind risk. That's where cracks appear but get dismissed. Buffett's been a net seller of stocks for 12 consecutive quarters. From Q4 2022 through Q3 2025, Berkshire sold more than it bought every single quarter. The cumulative amount? $184 billion in net stock sales. Not because these companies failed, Not because Buffett stopped believing in American business, but because valuations reached levels where he couldn't find good value, where prices didn't justify risk, where holding cash became more attractive than buying stocks at current prices. Look at what he sold. Apple, his favorite stock, his largest position. Berkshire owned over 900 million shares at peak. Now it owns 238 million. He dumped 74% of the position. Bank of America, trimmed by tens of millions of shares. These aren't stocks Buffett hates. These are stocks he loves that got too expensive. The S&P 500 Shiller Cape ratio hit 40 in November 2025. That's higher than any time except the dot-com bubble and the COVID peak. When valuations reach 40, historical data shows markets typically decline 30% over the next 3 years. That's not prediction. That's pattern recognition from a century of market history. Buffett sees this. The market ignores it. Stage 3 is the quiet shift. Happening right now. Buffett sold $12.5 billion in stocks in Q3 2025, bought $6.4 billion. Net seller for the 12th straight quarter. But here's what most people miss. He didn't just sell stocks. He stopped buying Berkshire stock too. For the first 9 months of 2025, Berkshire conducted 0 share buybacks. None. Buffett's always said he'll buy back Berkshire shares when they trade below intrinsic value. The stock fell 14% from its May peak to August low in 2025. Massive buying opportunity if Buffett thought the stock was cheap. He bought nothing. That tells you even Berkshire, the company he built, the stock he knows better than any other, isn't cheap enough at current prices to deploy cash. If Berkshire isn't worth buying, what is? Meanwhile, cash kept building. Started 2022 at $105 billion, climbed to $150 billion during COVID, now $381.7 billion, more than double the previous peak. The cash position now exceeds the value of Berkshire's entire stock portfolio. $267 billion in stocks, $381 billion in cash. Think about what that means. The guy who built his fortune buying wonderful companies at fair prices now holds more cash than stocks. He's positioned for defense, not offense. Stage 4 is the defensive bet. This defines everything. Buffett didn't stop loving stocks. He didn't lose faith in American business. He made a calculated decision that at current valuations, at current economic conditions, at current levels of market euphoria, holding cash is smarter than deploying it. This isn't pessimism. This is risk management. Because cash does 2 things stocks can't do during market dislocations. First, it preserves capital. When markets fall 30% to 50%, cash doesn't fall. It holds value. Second, it provides opportunity. When everyone else needs to sell, cash lets you buy at distressed prices. Buffett learned this in 2008. He's preparing to use it again. Now let me show you exactly what this bet represents. Buffett didn't stop buying entirely. He made one major new investment in Q3 2025. Alphabet, $4.3 billion position, his first major tech investment outside Apple. But even that's revealing. Alphabet trades at lower valuations than most mega-cap tech stocks. It generates massive free cash flow. It has dominant market positions. This isn't speculative growth. This is quality at reasonable prices. The exact kind of investment Buffett makes when he does deploy capital. But $4.3 billion out of $381 billion in cash? That's 1.1%. He's keeping 98.9% on the sidelines. That ratio tells you everything. Here's what Buffett's positioning means for you directly. This doesn't mean markets crash tomorrow. This doesn't mean you should sell everything and hide in cash. What it means is that the assumptions driving market behavior right now, that stocks always go up, that valuations don't matter, that AI justifies any price. Those assumptions are being rejected by the investor with the best track record in history. And when assumptions diverge that dramatically between the market and Warren Buffett, history suggests Buffett's usually right, and the market usually gets shocked when reality catches up. If you're invested in stocks right now, understand what you're betting on. You're betting the S&P 500 Cape ratio of 40 is justified by future earnings growth that hasn't happened yet. You're betting corporate profit margins at record highs can stay there indefinitely. You're betting interest rates don't spike, credit doesn't tighten, economic growth continues smoothly, That AI generates the trillions in value current stock prices assume. Some of those bets might pay off, but all of them have to pay off simultaneously for current valuations to make sense. Buffett's betting, they don't. If you're saving for retirement, think about what happens when markets reprice risk. You don't lose everything, but you might lose 20% to 40% of portfolio value. If you're 60 and planning to retire at 65, that loss changes everything. Recovery might take 5 to 7 years. You might be 70 before your portfolio gets back to where it was at 60. That's not catastrophe, but it's also not the plan. And it's exactly the kind of slow wealth destruction that happens when people assume markets always recover quickly. Sometimes they do, sometimes they don't. 2008 took 5 years to recover. The dot-com crash took 13 years for the NASDAQ to get back to peak. Buffett's positioning to avoid that pain. If you're younger with decades until retirement, market volatility matters less. You can ride through corrections. You can buy during crashes. Dollar cost averaging works over long time frames. But even for young investors, understanding cycles matters. If markets drop 30% and you keep buying, you'll do well eventually. If markets drop 30% and you panic sell, you lock in losses permanently. Buffett's positioning is a reminder that markets don't just go up, they cycle. And right now, we're late in a cycle that's been running since the COVID bottom in March 2020. 4.5 years of nearly uninterrupted gains. History says those don't last forever. Now let me address what you're thinking. Markets have been expensive before and kept rising. The CAPE ratio hit 40 in late 2019 and early 2020. Markets kept climbing. Why should this time be different? Fair question. The difference is context. In 2019 and 2020, interest rates were near zero. The Federal Reserve actively supported markets. Corporate earnings were growing. In 2025 and 2026, interest rates are above 3.5%. The Fed ended quantitative tightening, but isn't aggressively supporting markets like before. Corporate earnings growth is slowing. The backdrop that justified high valuations during COVID doesn't exist anymore. Buffett sees that. The market hasn't adjusted yet. Here's what Buffett's actually betting on with his cash position. He's not betting stocks crash. He's betting that at some point in the next few years, probably sooner rather than later, valuations will adjust to reflect slower growth and different rates. When that happens, the companies Buffett wants to own will trade at prices that make sense, and he'll deploy that $381 billion in cash, not all at once, systematically, buying wonderful businesses at fair or even cheap prices. The same strategy that made him wealthy over 60 years. He's just waiting for the right pitch, and right now, the market isn't throwing strikes. It's throwing overpriced pitches Buffett refuses to swing at. Let me show you what this looks like historically. During COVID crash in March 2020, Berkshire sat on $128 billion in cash. Markets fell 34% in 3 weeks. Buffett deployed capital selectively, didn't catch the exact bottom, but bought quality at reasonable prices. Those investments generated billions in returns as markets recovered. Same pattern played out in 2008 and 2009. Berkshire entered crisis with cash, deployed during panic, made enormous returns. Now Berkshire has $381 billion, 3 times more than during COVID. Buffett's preparing for something bigger or sees opportunities coming that require more capital than ever before. Either way, he's not building this pile because he's running out of ideas. He's building it because he knows what comes next. December 31st, 2025, Warren Buffett officially stepped down as CEO. Greg Abel, age 63, took over January 1st, 2026. Buffett remains chairman. But day-to-day management, capital allocation decisions, strategic direction, those now belong to Abel. This transition matters for one critical reason. Buffett wouldn't hand over control if he thought the next few years required aggressive stock buying. He handed over during unprecedented cash accumulation because the hard work of building defensive position is done. What comes next? Whether deploying that cash during market distress or managing through economic turbulence, that's Abel's job. Buffett positioned the company. Abel inherits the strongest balance sheet in corporate America exactly when it might matter most. Here's what the market says versus what Buffett says. The market says valuations are justified by AI growth. Earnings will keep rising. Economic expansion continues. Stocks are the best place for capital. Buffett says cash is better, valuations too high, opportunities scarce, patience required. One of these perspectives will be proven right over the next few years. History says betting against Warren Buffett during periods like this is expensive. Because Buffett doesn't panic. He doesn't overreact. When he builds cash positions this large, he's not being fearful. He's being rational. And the market's being emotional. Here's what you should actually do. First, understand your own risk tolerance and timeline. If you're 5 years from retirement and heavily invested at current valuations, you're exposed to sequence of returns risk. A correction in the next 2 years could permanently damage retirement plans. If you're 30 years from retirement, short-term volatility matters much less. Your actions should reflect your specific situation. Second, consider whether you're comfortable with current valuations. If you think the S&P 500 CAPE ratio of 40 is reasonable and sustainable, stay invested. If you think it's elevated and likely to mean revert, consider reducing equity exposure. There's no perfect answer, but alignment between beliefs and portfolio matters. Third, build cash reserves if you don't have them. Not because markets will definitely crash, but because having liquidity when opportunities arrive changes everything. Buffett can make investments during crashes that generate decades of returns precisely because he held cash while everyone else was fully invested. You can't replicate Berkshire's scale, but you can replicate the logic. Fourth, stop assuming stocks always go up. They don't. Over long periods, they tend to rise, but decades matter. The Nasdaq peaked in March 2000 at 5,048. It didn't permanently exceed that level until April 2015. 15 years. If you bought at the peak and held, you eventually recovered. But 15 years is a long time. 15 years during prime earning years or retirement years can't be recovered. Buffett knows this. The current market acts like it doesn't. Fifth, recognize that legends don't chase returns. They avoid traps. Warren Buffett at 95 has nothing to prove. No performance fees to earn, no investors to impress. He could deploy that $381 billion tomorrow into stocks and generate enormous short-term results if markets keep rising. He's choosing not to. That choice carries more weight than any analyst report or market forecast because it's backed by 60 years of being right when everyone else was wrong. When Buffett moves, the system is speaking. Right now it's saying valuations are too high. Risk is underpriced, patience is required, you can listen or ignore. History says listening is smarter. The most important thing Buffett did at age 95 wasn't stepping down as CEO. It was positioning Berkshire to survive and thrive through whatever comes next. $381.7 billion in cash, $267 billion in carefully selected stocks, 0 share buybacks despite stock weakness, 12 consecutive quarters of net selling. A new CEO inheriting the strongest balance sheet in corporate history. This isn't pessimism. This is preparation. This is what smart money does when everyone else is euphoric. It builds fortresses, conserves capital, waits for opportunity, and when opportunity arrives, it acts decisively while everyone else is paralyzed. Here at Next Generation Finance, we track these moves because they matter more than headlines. Buffett's biggest bet ever at age 95 isn't against America. It's not against capitalism. It's not against stocks as an asset class. The bet is against current valuations. The bet is that patience will be rewarded when prices adjust to reflect economic reality instead of speculative enthusiasm. That bet might take months to pay off, might take years, but Buffett has time. He built a company that'll outlive him. He installed a CEO who shares his philosophy. He positioned the balance sheet to wait as long as necessary for the right opportunities. And when those opportunities arrive, when markets panic and everyone wants to sell, Berkshire will buy, not emotionally, systematically, the same way Buffett bought during every crisis of the past 60 years. The biggest bet ever isn't buying, it's waiting. Waiting with $13.5 billion in quarterly operating earnings, waiting with $176 billion in insurance float, waiting with businesses that generate cash regardless of market conditions, waiting with $381 billion ready to deploy when prices make sense. At 95, Warren Buffett just showed you exactly what waiting looks like when you have nothing left to prove and everything to protect. The fortress is built, the cash is ready, the discipline holds, and the next chapter will prove whether markets or Buffett understood reality better. History says, bet on Buffett. The market says, bet on momentum. Choose wisely, because one of these bets will define the next decade of your financial life. If you found this breakdown valuable, if understanding these market signals before they become headlines matters to you, hit that subscribe button right now and ring the notification bell. Because here's the thing, we're the only channel breaking down what the smartest money in the world is actually doing versus what they're saying. Drop a comment and tell me, are you building cash like Buffett or staying fully invested? Let's figure out together which side of history you want to be on when this resolves. This is not financial advice. Always do your own research and consult with qualified professionals before making investment decisions.